So today's lesson is going to go over a brand new technique called expected volatility or expected range. Now, you may have heard this term in regards to options or this term in related to earnings, right? People calculate an expected range based on some, sophisticated math and indications that can show you that in other trading platforms. We're going to show you the best way to do it, and our way is better. And it's very simple. All you do is you go to daily mode, and you go to auto on your liquidity map and type in any ticker at all. I'll demonstrate it here. So we hit Netflix, and you have Netflix has popped up. And of course, I'll go to functions just to kind of show it here. Netflix, hit enter. And you'll see that on daily mode, and this is just reiterating what's drawn on the chart, is that with 320 and 315 is that distance between bull zone and bear zone, right? So the neat thing about what this is saying is that bulls and bears are expected to be at minimum 5 points apart. And again, that's reiterated here. The distance between the zone is just squashing all the walls together into a single block. The distance between the zone is 5 points. And what's neat is that you'll notice that this is basically Wall Street's pre-positioned risk or testament of where they want to be long and short this stuff. Everybody that wants to be long Netflix, if every bull and bear are in a room, they're at least 5 points away from each other, whether it's 10, 20, 30, 40, or 50. The minimum span between a bull and a bear, if a bear was going to poke a bull with a stick, it needs to be 5 points long. So it means that if a bear and bull need to connect, right, a buyer and seller need to find each other, they need to connect at minimum a distance of 5, which means the best hope you have of finding a seller for a buyer or a buyer for a seller is a 5 point span. So just in this example, because I asked somebody to give me a random ticker, they said Netflix, I'm just drawing a box, a random purple box, the distance between the call zone, input zone, or bear zone and bull zone, to show that bears and bulls are expected to be at least 5 points away from each other. And what you'll see that's a really, really neat artifact, and this is just a beautiful example of it, is that when something is moving up or down, forget liquidity maps or DD or resilience for the moment. Just think of the general mechanics of market. When something's trading lower, it means there are sellers, right? And so market makers would need to find a place where buyers will be. If markets are going higher, it means there's buyers. Market makers will raise price to find where sellers will be. Well, didn't over the course of however many days in the past, did people tell the market that they want to buy and sell from each other at least 5 points away? So would it behoove you to see the coincidence, because it's not really a coincidence, that when price raises, it's looking for sellers, and they're going to move 5 points at minimum to find them. So it's like the market maker will span that same range no matter where that thing is trading, because that's the expected range to find buyers and sellers. How do we know? Because what a bull zone and bear zone is, if you remember the relationship, it's very cool. We'll talk about liquidity again, is when a bull is a person that longs the market against a bull, somebody that buys something to hold it. A bear is somebody that shorts something to hold it. When a bull and bear find each other and trade against each other, it's called a liquid trade. When there is no bear and a bull trades to a market maker, right? Where a bear trades to a market maker, that's called illiquid, right? So when markets are illiquid, that's when the market maker, in this case, there's a bull buy from the market maker, they have to be the bear by default, but they're also going to buy a call to go with it. And that call is right there in that wall. So we find the market maker calls. We know there were bulls here, right? You remember this is your liquidity map training. And then the other side of the coin, we know where the puts are of the market makers. So we know where the bears are. So when markets are illiquid, it's when you're in either one of the zones. You have more bulls than bears. In this case, you have one bull and no bear. In this case, one bear and no bull. When you have more of one than the other, when the market's illiquid, when it's not balanced. When you have a balance, it's liquid. So in illiquid markets where all the bulls, and we always say, like, we did this today on the stream, but it's like this, right? There's a room, and actually, let's just say this. Let's say there's like a big old room. It's like a voting booth or like a career fair. You go in, and then there's like a little kiosk that says bull, and the kiosk that says bear. And there's like a leader there that's standing there, and there's a leader there that's standing there. And he's like, hey, man, you come in the door. He's like, hey, I want you to buy my stuff. Hey, man, I want you to short my stuff. As you negotiate with either one of these, they're going to scoot their kiosks back and forth, right? This is your traditional auctioning process in the stock market, right? You have a bid and ask, screaming at each other, trying to get your business, right? So as people decide what they want to do, these kiosks can get further apart. And so how far away the bulls and bears are from each other, it doesn't matter when or where you bought. If this is the minimum of where bulls are, then all the bulls are going to be standing anywhere inside of this room. Like, doesn't matter how big the room is. And all the bears are going to be standing everywhere in this room. But to be one or the other, a bull or a bear, in periods of illiquidity, when you're trading against the market, which are these guys, you're going to be at a certain distance away from them, but they know when you traded against them. So they know their risk because they have bookkeeping. They know exactly their risk. They know where their puts are and where their calls. Every market maker in town knows exactly where they bought and sold to traders because they bought and sold to traders. They literally account for all of it. So if they know when I'm on the other side of the trade and I was the bear, and I'm on the other side of the trade and I was the bull, I scooted my booth 5 points away as I found the average of where everybody was, or that minimum distance where they're going to be. So I know that that's the distance where bulls and bears are. And if immediately bears come in the market anywhere and I'm looking for buyers, well, from my previous history in a short-term time ago in the market, I learned that, well, bears are like 5 points away. So I'm going to lower price 5 points to see if they're there from anywhere, because I know bulls and bears like to stand 5 points away from each other. How do I know? They told me. They bought from me at that distance. They literally walked in and told me what they wanted. Now I know what they want. So we're trading 50 points higher. There's a wave of sellers. Okay, let me drop it in 5 points to find the distance. Does everyone understand that you're seeing market making at its purest and finest? Example. Yes, in chat, we got it. Does that make sense? We literally tell them how far away we are from the bears if you're a bull, or how far away from the bulls you are if you're a bear. So at any point in time, the market maker can make a choice, right? Market's just lollygagging along, and a catalyst comes, and everybody's buying, right? Market's illiquid again, one-sided market. How far up do you think the market's going to move, at least the first run of Netflix, as they're approaching a higher price to find a seller? How far do you think it's going to move? 5 points. What if it moved 50 points? Sure, but it will move at least 5 points because that's at least how far it needs to move to find the other side of the trade. So if the market moves 5 points and comes here, that event wasn't a catalyst. It hit a normal range. It hit the expected move. You move 5 points, damn, there were some sellers there, right? This is the expected range or the expected volatility. And volatility is the expected wiggle. I always call it the wiggle or the wobble or whatever, how far price is going to move when it's actually flat. This is your volatility getting bigger. Is your volatility getting smaller? So this is your expected volatility. So if the catalyst, or the event breaks, now we do the same thing with risk intervals, right? Risk interval is a very similar process in the futures market. And for the S&P, we measure catalysts by it moving more than a risk interval. So how do you measure a catalyst in a stock? Take a guess, because you've never had this technique taught to you before. Is if you create a red line or an anchor point in the stock and it moves more than this distance. This is your catalyst video for stocks. So when earnings come up, if it spans more than this distance, then that's a catalyst. So typically, this distance is very well defined. So an example would be a stock that has earnings coming up. You can literally tell exactly what the expectation of that distance is. What do we got that's big? We have Eli Lilly coming up on Thursday with Apple and Google. Let's just take a look at Lilly, right? So the neat thing, just to kind of reveal back to Netflix, is that as Netflix is moving up or down, even in a flat day, it's spanning a distance of expected 5 points because you're going to have random noise. Bulls and bears are going to randomly step in. So in this case, bulls randomly stepped in and the market moved a 5-point range. And sellers stepped in, the market moved a 5-point range. Buyers started stepping in, it moved a 5-point range. You can see that in scalping or day trading, you get a good feel for that particular range. And I'll tell you a couple of cool tricks with this. Lilly, let's repeat it, right? It is a very good gauge of a lot of stuff. Now, I don't know where the walls are today, so let's skip Lilly. Let's see what's going on here. Some weird artifact going on. Okay, let's skip that. Not really sure what's going on, but we'll move to Apple. Apple has 2 expected ranges. You take the closest one. Apple's currently trading here. Inside of this illiquidity that surrounds this liquidity, there's your range for Apple. There it is. There it is, right? It's liking that range. What else do we have? Amazon. I'm just looking down the list. Amazon. These are all things with earnings. So the neat thing that you'll see is that Thursday earnings are going to be based on Friday options, right? This is the overall expectation of today on the daily. 94 to 93, it's a 1-point range. And again, you can see that we're moving 101.7 to about 102 and some change. It's again a 1-point range. You can do this all day long with any stock. It's great. The setting is daily mode, auto depth, auto. You take the nearest liquidity pocket, and in your scalping or your expected move or even your catalyst, you're not expecting the market to deviate. Even though it moves generally further than that, the waves or the bumps are going to be that distance. Right? You start to find sellers at the top, and look at this. Market makers are pivoting exactly to the bottom of the box to find buyers. So anytime you pivot, your brain needs to snap into, this is how far it's likely going to dip if I want to buy. If I were a bull in Amazon and we hit a top and we've been trading down, I've been waiting all day. This is my long spot if I'm bull for the dip, right? If the market pops and I want to short, I'm going to know it's going to likely move in 1-point burps as well. So the neat thing is that every time it dips, you can remeasure it. Anytime you get a news event, you can measure it. It's just, you pick a stock, it's always that. The reason market makers move price up and down to find buyers and sellers is because we told them the pattern of when we're buyers and sellers. So if you want to get even faster, if you go to single date and you look at just the Friday options, right, for the things that have earnings this week, as we see Amazon's earnings are the 2nd of February. So let's do February 3rd, right? You can see it's still that amount. Let's do Amazon here. So auto and daily mode, if I were to do single dates, you can see that it's reiterating what you see here, 94, 95. It's not expected to have a big range going to earnings. So that may change tomorrow or Thursday. Certainly will likely change, but going into it, market's really stable at this current price. So just to give you a little heads up, I haven't seen Amazon in a while, but I was going to assume it's probably reverted to the middle of the last wave down. So normally the market finds equilibrium on bigger moves to kind of walk to the middle even before earnings. So the day of earnings, you want to run single date of the next available option strike, or sorry, the expiration after earnings. So all stocks, right, will expire weekly options on Fridays. So on whether it's something with earnings today, which is Tuesday, we have AMD, or something on Thursday, Google, Amazon, Eli Lilly, whatever, you're going to look at the Friday options that morning, right? Which will give you that spread that will go into earnings. So whenever you're trading into the earnings report, you know that you have a certain distance. If it stays in that range, which usually happens. If it breaks out of that range, it's a big catalyst. So options traders tend to make those trades that span that range, right? You can bet that it doesn't leave that volatile band. You can sell calls there and sell puts there, and very likely it's very rare that the market moves so abnormally against Wall Street's pre-position unless it's a massive surprise. And I'm not talking a beat or a miss, because everybody is betting beat or miss to a degree. But if it's a beat by a magnitude of like 5 times the amount, everyone's going to change their mind and you'll break through that range. It's very rare that Wall Street doesn't estimate earnings correctly or in the range. That's why, like, when you try to buy puts or calls going into earnings, it doesn't break the expected range, and the expected range is built into the premium through how IV works. And not going into a detailed class on IV, but you'll pay an abnormally high premium because that expected volatility is pre-built into the price leading into earnings. And you only keep that IV premium if it breaks through that expected range, which is the rare event. So smarter traders will trade up to earnings and dump the position, right? And they want to get out of the way for what we call the IV crunch, is that if you don't leave the expected range, then the premium just collapses. If you're inside of that range, your options strike inside of that range, right? So a cool little trick is just doing that. So you'll want to look at the single date that's leading into earnings. Now, a trick with monthly map, somebody's asking, what about monthly map? Okay. So let's do monthly map on Netflix. Okay. So monthly map is the same principle, right? Is that let's zoom out on the monthly map. Let's just go to let's actually go to an hourly chart. Wait, random target touched. Was I actually marking up my chart at some point? Oh yeah, I use this for the window of opportunity example. Okay. So let's go here to monthly map and let's draw a monthly map, right? This is something that will be automated very soon in the Rockscooter platform, but you project volatility in the same way a month in the future for you swing traders and investment traders. This is one of the best tricks you can do. Let me see if I can't clone this box. I know this is drawn on here. Can I clone this? I can't. Okay, let me draw the blank one. Okay. I'm just going to draw a random box. I'm going to try to make it the same gray color. Oops. Light gray. I'm just kind of mimic that and mimic that. Okay. And I'm going to try to make a lighter gray one. And I'll show you what's really cool about monthly map is that you can project volatility or expected ranges a month in advance. That's the better part. And so when you're trading, you can get a good storybook as to what the market's expecting or even see catalysts before they happen. So let's look at Netflix for an example. And I'll use the walls widget so I don't have to leave the screen here. But what you'll see is when Rocket Scooter has monthly map, you'll literally click a button. This is monthly map. It's delayed another week. I thought we'd have it by this Friday, but it should be coming out one more week because I just had a meeting today on the API. We're into the Zoom call and we're still ironing out some kinks there. So what I'll do is I'll type in Netflix and I'll do manual mode and I'll start plotting each weekly options expiration one at a time. I'm going to project Netflix a month into the future, right? So I'm going to pick the 3rd of February, which is the next one coming up. So this is today's daily walls. Let me go ahead and zoom out here and let's go to the 3rd of February, which will be Friday. Let's just go all the way over here. I'm going to take this guy and drag it to the 3rd of February, and it shows me that 350 to 315 is that expected range. That's pretty massive, right? So I'm going to just put the bottom of that box at 350. All that matters is the distance between them, so I don't care about the top of the box right now, and then 315 is the bottom. So you can see that Netflix, oops. And the neat thing is monthly map will draw this for you. Netflix gets surprisingly more volatile over the course of this week. Man, something's going to be happening between now and Friday. Why is the market getting a little more volatile between now and Friday? Is anything happening between now and Friday? Anybody got any idea? No, what's happening fundamentally. You see unusual volatility your brain can go, whoa, wait a minute. The expected range of Netflix is getting really big in this week. They have earnings coming up. When's Netflix earnings? That is Wednesday. Whoa, yeah. The FOMC is Wednesday. When is Netflix earnings? Let's go look, right? Let's type in Netflix. Right. So I'm teaching you what you do as a trader. This would alarm you that something very big is happening this week, that this range expected to get bigger. Do we all understand? So that's the whole point. Netflix has a call on, they just did their call, didn't they? The 19th. So Netflix earnings was already happened on the 19th, right? So that was way back here. That looks like that was the day. So it's not earnings. We eliminated that possibility, but it is Fed, which is tomorrow. Could it be sympathy with Disney? Oh, it could be sympathy with Disney, right? A sympathy trade that if Disney's looking bad, Netflix can look bad, right? You guys are thinking outside the box, which I love. Y'all are all so smart. Love it. Okay, let's check out Disney. Disney report date is the 8th of February. Let's prove that thesis. There's sympathy trade would come in the next month. With Disney is the 8th of February. Let's do the 10th. Great call. Let's test out that thesis. I like how y'all think. So 310 to 280. Very, very, very much so, because what else is happening inside of here for Netflix? Nothing. So you might be onto something, Humble, because there certainly is a little bit of volatility when Disney earnings is there, right? Disney and Netflix have competitive streaming services. So of course, if Netflix, likely Disney's probably sympathy trading with Netflix, but if Disney starts looking better as they're kind of offset by about a month or so, then Netflix would likely experience a similar trade, just like if CVS does bad, Walgreens will do bad, or if Kroger does bad, Costco could do bad, or Walmart can do bad. You know what I'm saying? Things in similar ballpark. We'll have this, what they call a sympathy trade. When one does bad, it could be a greater window of the industry in general, right? So greater fundamental. What you'll see is that there is still a 30-point expected range for Netflix here and here. Netflix, Fed can explain this volatility, and the volatility does not subside over the week. So it's like Netflix is going to be on edge for a while. So lots of volatility weeks out can mean lots of great trading, right? Lots of good, big, fat moves on Netflix. It doesn't mean it's going to fall, but it does mean the expected range is going to be much, much, much bigger than it is now. And Netflix is mildly trading now. And you can plot out a month out and see what it looks like. And even into monthly expirations, the same thing, right? The 17th, 300 at the base. I'm showing these boxes. And this is what monthly maps are going to do. Right. 250. Oops, these right there. So you're talking, it even gets crazier going into monthly expiration, which you'll probably expect a lot of stocks to be like this. So Netflix is a volatile ride for the month. And it seems to get worse as the days go by. And that's not going to be uncommon for this environment, right? And your monthly maps will look like this, which is kind of cool. It's going to show you like a competing bull zone. Anytime these little legs get further or wider from each other, volatility is going up. Anytime they shrink in, volatility is going down. So you can see right here, over the course of the month, Netflix has the biggest change in volatility this month. So you can imagine that anytime in this week that's important, when there's a catalyst, imagine the Fed on the 1st tomorrow. I'm going to do this again tomorrow, leading up to the Fed for anything I'm trading, and understand that if Netflix, like pretend that this, okay, whatever this distance is, right? Let me move my mouse here. Is going to be an example. 350 and what did I say? 320. So a 30-point range. So say that Netflix trades up and trades up and trades up in the Fed. And right before FOMC, Netflix has a hedge pressure right here, and it trades, and it's 30 points away. Here's a trick. I want you all to answer this question. The market's been rallying. The FOMC raises rates 0 instead of the expected 25 or 50, right? So there's a change, a nice bull change. Market kind of moves up a little bit and then dips 30 points to hit hedge pressure. And this distance was 30. What would you do at that hedge pressure? It fell exactly how much you thought it was going to fall. It tried to pre-trade up into that. It fell exactly 30 points in hedge pressure, which is exactly the expected distance. How heavy would you buy? Everybody's saying buy it. Okay. I can buy. I believe that. I like that. Would you go in heavy? Or would you go in light? Owen says, yeah. Zelo says light. Kevin says heavy. I'd go in very heavy. Why? If y'all get this right, I'll be so proud of you. Everyone's saying heavy, and one person says like, it's up to you. And your risk is your risk. There's no right or wrong answer. Why would I go heavy? Remember what Matt says. Don't give me a rocket scooter reason. Give me a basic fundamental understanding of why I bet how much I bet. I bet heavy when I am what? And light when I am what? This is an example. Owen saying expected move was made, so probability of an outsized move beyond that is low. Yeah. Certain, uncertain, sure, not sure. Yeah. So heavy when I'm sure, or when it's like this example, I know exactly where I'm wrong, which is literally 1 point below hedge pressure or any points below that expected range. So because my stop is like literally butt to butt against hedge pressure, I'm very sure that I know when I'm wrong. So I'll go in heavy because I have a very tight stop. Like if it goes 1 point below hedge pressure, I'm very sure that I'm absolutely wrong. It's R&R at its best, right? Yeah. So I would go heavy, not for anything mechanically, but because in that example, it's rarer to see you break that range of expected range. It's rare that that happens because Wall Street's very smart at inside information. Thank you, corruption, and trading things in before it happens and knowing what things are going to do. And market makers see the map because they're trading against us here and here. So they know they're going to lower price to find buyers. I know my stop might not even can be a full strike distance, even 1 point below or 2 points below. I'm ready to start closing out. So since my stop is literally right there on the edge, I'm going to go in heavy because I go in my maximum bet. Just think of a BLU at hedge pressure, right? I'll long at the open, but I'll take my heaviest bet right at hedge pressure because my stop is literally on the other side, right? So my confidence is not confidence that I'm right. It's a lower probability that it doesn't break the range. But again, you can't predict the market. Sellers could have hated that news and dumped it. But because I know as soon as it starts breaking 30 points, I'm starting to sweat. I know exactly where I'm wrong, right? And I'm 100% confident that I'm wrong and I'm out. So since my confidence, either being confident or being right or being confident in where I'm wrong, both of those allow me to bet heavy. You're never going to be like 100% confident you're right. But the best thing is you can always be 100% confident that you want to get out of the trade or you're wrong. Hedge pressure breaks, I always get out of the way. So if it falls right to the edge and it's the expected range, that's my best R&R I can get. And I think Owen nailed it. R&R is best. I mean, there's no second entry. My stop is right here. I either get it or I don't. As a matter of fact, volatility range like this, I can easily scalp it back to the middle, close everything out, and then let it subside. And then pick a side with a smaller position to take the gamble rally or the gamble sell, right? Big volatile moves. I love to trade that expected range just to test the midpoint of that range, right? This is a red line at its finest. And that's another trick we do teach. So a lot of these things are pretty cool. And I hope that you guys are here every single day. You're learning hopefully something more mechanical about trading, right? This is not just your average look at the charts crossing over by the dip. right? You're understanding more of the principles of how markets move, right? Market makers are machines that follow rules. And we literally hand them a blueprint of where we want to buy and sell. So that blueprint happens all day long, right? And the idea is that monthly maps are going to help me understand that I need to pay attention to something in the market. Today being the example is something's happening here, here, and here on Netflix. Well, why is it getting more volatile on the monthly map? And I'll revisit one more example of the volatility range, not just spanning out in time, but actually looking for scalping in the day. So this is like swing traders and day traders. Well, we have FOMC here on Wednesday. So those Friday options are baking in some volatility. We have a Disney sympathy trade, right? That's how you spell sympathy, I think. And again, the volatility is still there. And then you have monthly OPEX, right? Which is here. Always volatility, right? So Netflix can have a very torturous month. And also, just to double check, why don't we check Disney in the same light, just to verify your sympathy trade idea, right? And I'm pretty sure, and I'm not going to plot it just to save some time, but let's do Disney, right? 5 points on the monthly. Okay. Disney's earnings. Ooh, 10 points in earnings. And that does make sense. Disney's earnings will be more volatile than Disney monthly, and everything's earnings always be volatile. In Disney today, 5 points. So this Friday, 5 points for FOMC. Disney becomes 10 and then becomes 5 again for monthly. So you were right. This volatility in Netflix is likely justified by an increased volatility in Disney, a sympathy trade. And you see that with Rocket Scooter. Good job. All right. Love it. Okay. One more thing. Let's look at SPY. Now, SPY does have typically on most days and I've already pre-done this, but usually in normal non-volatile markets, what does a normal market mean? Normal market's a futures word. Normal, if you ever read it in textbook, means the market's in contango. Futures, don't worry too much about it, but this goes into your triple B stuff. So when you're in a normal market, it means that VIX is in contango at the start of the contract month. Let's go ahead and go here. In Rocket Scooter term, we say this thing called a triple B. Anytime you're below here, markets are nice and stable. When markets are down here, that's SPY wall and that QQQ wall are going to be nice and tight. When the market is trading in contango, right? Which means this contract is priced lower than this one, and you're trading above this triple B, then those SPY walls they tend to get a little wider. Somebody said, well, SPY is pretty much always 1 point. Well, it's because we've been in contango for a couple of months. We've literally been somewhat in a bullish-ish market, right? Since the recession kind of bottomed out in October and the market's fighting to see if it goes lower. Since then, we're in contango below triple B, in contango below triple B. And this mechanic for the last 3 months does create a tight SPY because that's exactly what happens. It's expected volatility. It's baked in, prices out, and then the market just gets tight. Nice, clean days. I love trading this last 3 months. You might see me have a high win rate on the contest right now that I'm doing. But that's because this kind of trading is very easy compared to volatile trading. I love to trade as much as I can when you're below triple B because pivots tend to be sharper and less overshoot. There's a whole nother lesson in that, but it's an easier environment, certainly, than being above triple B. When markets are volatile, pivots overshoot more, and I wouldn't take risks like I did today in that environment. But you'll see that these walls are tight. Somebody says, well, isn't SPY like always 1 point? In this environment in the last 3 months, yeah, but I'll promise you something. We start breaking that triple B and SPY is moving, or VIX is up in, 25, 28, 29, you're in contango, and then it keeps rallying. You'll see some ranges on SPY that get really big. As a matter of fact, you'll see the CME group raise the margin requirements in futures when that happens, which will raise the risk interval at the same time. So you will see that when the risk interval has been 29.5 points for ES for gosh, how long? Like a year, probably. Well, it was probably 31 or 32 a year ago, right? At the peak of the market. So at the first of the selling, right? So it's not changing that much. So the distance is not changing that much either. But back to what SPY is, right? So you have two competing things. SPY is a 30 point or 29.5 point risk interval range, which is the span of that futures risk, right? It's a whole nother class on that, but SPY itself, while tracking the futures or tracking the index, SPY mechanically also moves in little burps of that distance. So when somebody said, SPY seems to always be about 1 point, it's the environment you're in. And you will see that there will be times when it's not, when it's more volatile. But even so, this 1 point of distance exists here. Market moves on an event. We had consumer confidence numbers come out today. Market dipped a point, came right back. That's the example I said earlier, right? If the market's trading and it falls to an area, which today it fell to half gap, when resilience has been nice and strong and positive today, the rocket scooter method is I buy at half gap for a move. Now, again, this is a mean reversion. So, the day is practically over or random from here. There shouldn't be a trade. But because I was live streaming on a podcast, I did force a trade, which is not something we teach people to do. And typically in mean reversion, we sit out once the window of opportunity is closed. But today I longed to bet that we supported resilience to close across the other side. So I was actually taking a very risky trade just to say that we span from one side to the other. Why? Well, there's 1 point of range. DD's positive, resilience is positive. So the market's going to try to push higher, but even had a hedge pressure limit. So I didn't do anything. I literally closed out right here. I got a tiny little position. An event came out that spanned the expected volatility, which didn't shake me out. It fell to a resistance, as the earlier example was if it fell to hedge pressure. The R&R was really tight, as somebody just said, R&R at its best. Now, again, the day is over because the window of opportunity is closed. But for me to take a gamble, I did add here again, and I acknowledge, hey, this is a gamble. It's not something we teach to do, but I know my limit. My stop is very tight. So I doubled down right here on that event. So I waited for the event to drop like a rock. Y'all saw me pile in right there. And right there, I closed all of it out, right, for 3%, which is a really good trade, 3% in the account. And I literally closed it out. Well, why? Because all the signs are pointing that's going to be choppy and stay here. There's no sign that it's going to break, but hey, look, it did break, right? Market's nice and strong today. People are getting out of the way of the Fed, but you can see that as it's breaking, it's still moving in practically every dip when buyers are found, it's raising a point to find sellers. And you can see that like over and over and over. And I'm just going to clone the box. And every time it dips, and buyers are found, market makers span 1 point to find sellers, and then it dips and markets find buyers and it goes a point to find sellers. So you see the waves after the dip, you go up a point, and after the dip, you go up almost a point. And then after the dip, you go up a point. Do y'all see that? Like once you see this, you can't unsee it. And you will see that things that are rallying tend to move up this distance and down some distance less than that. If it moves down a distance more than that, then that's a sign that it's reversing. That's a good signal of a reversal. If the market moves more than a distance of this, it's a good sign it's continuing to rally. As right now, it's moved more than a distance of that before it found a dip. It's a good sign it's going to rally in the longer term, right? So you had two breakouts of the expected volatility range before you had an actual retracement of that range as another trick to tell you the strength of the trend. So imagine, as our class appropriately, all know what I'm drawing. This is pretty much like an IRL is going to exist right here, and an IRL is going to likely exist right there. So if you span a distance more than the expected range and don't return to like the halfway point, it's a good sign that that is your breakout. Buyers are overwhelming the sellers, even at the edge. So who do you think is jumping in at the edge here? Shorts are getting squeezed, and shorts are getting squeezed, right? to add this to RS, yeah, the monthly map package will start to detail these ranges. So an idea will be that we can have all kinds of graphical implementations of this, but the idea is that we just want you to see that, right? I do the same demonstration in the risk interval video. It's very similar in that effect, but you'll see that when SPY is rallying, you're moving up to find sellers. It's going to move up in this distance in waves. Even though it's really hard to like predict where those highs will be, you'll know that if you get whatever reversal signal you want, you're looking for that distance, right, for your scalps, which is why I only took that distance right there. Now, why didn't I long right there? Well, it's irrational on hedge pressure breaks. And it's random after you pass the middle. So window of opportunity was closed. And this is, you can take other techniques, but smaller position if you do trade outside the window. We don't tell people to try to trade outside the window, but you do have a lot of evidence that once you had this breakout of the expected range and support at hedge pressure, DD being positive, that's the support right there. Hedge pressure breaks are rational. Your volume spiked and decayed, which is the thing we teach you. And when that spike and decay happened, you found higher highs, which is breakout. And then, of course, resilience is long and strong, which means outside of the redistribution zone, that's also support, right? So strong support, strong indication of no volume. And then we're burping outside the expected range, not once, but twice, showing that shorts are covering before Fed. And you get like the best storybook you can of why the market's doing what it's doing when you use rock scooter stuff. Y'all feel like you learned something today? Like I learned something today. I love talking about this stuff.